Thank you for staying with us. Now, joining us for a conversation on the operations of Cafca is the Chief Analyst for Equity Access, Respect Kwenzi. Respect, good evening, and thank you for joining us on the Earnings Review.
My pleasure as always. Thank you, Evan.
Fantastic. To get the ball rolling,
sure.
Can you give us the backdrop in terms of the operational environment on which we are having this conversation? And of course, this conversation is coming in shortly after the release of the results for Cafca for the year ended 30 September 2020. Can you give us the detail, the backdrop that would be relevant in setting the tone for the conversation?
Thank you. So the operating environment has indeed been tough. I mean, we are still facing the same challenges that we carried over from 2019. 2020 so far has been a bad year. When you look at the broader overarching GDP growth, we are projected to be going for a crash, minus 10 to 15% on some of the most bearish projections. On the positive, I think obviously government is projecting a more moderate decline in terms of GDP, but overall we are definitely headed for a crash. For 2019 as well, it was that backdrop of weakening economy, drought coming in, austerity coming in, and broadly the economy obviously went southwards as well. So for companies, it was also not good, just realizing a decline in terms of broader aggregate demand. So this is broadly the environment that you're operating in, but looking more precisely, some of the key elements there that have contributed to the economic outturn are mainly inflation, but also inflation is a function of the exchange rate. So since liberalizing in 2019, the ZIM dollar went on to crash about 87% against the USD in that respective year, and then moving into 2020, a depreciation of more than 30% just over the past few months alone. So I think such a volatile macroeconomic environment has resulted in obviously disaggregation. When you look at business, they haven't been able to keep on pushing at the same levels. You're finding demand weakening in some respects, but the good thing here is we're beginning to see pockets of demand emerging in the economy, and it's interesting really to look further into what's really driving that. But the overarching view is that the economy has been underperforming, and it has been driven by these macroeconomic challenges.
Now, if we then get into the financials, there has actually been an increase in as far as the profit position is concerned in inflation adjusted terms from 1.3 million Zimbabwean dollars in the 2019 financial year up to 1.6 million Zimbabwean dollars over the 2020 financial year. Can you give us insight into what could have informed that very performance?
Yeah, so the more precise point to look at is when you use your inflation adjusted numbers, and on revenue we are seeing a 24% increase in that aggregate. Of course, in historical terms, that's a triple digit level. So I think the company outperformed, but the context under which it outperformed is worth looking at as well. They drove more on the export sales than they did on local sales. What's the nature of their produce? The nature of their produce is that it's highly concentrated within a few buyers. When you look at the ZIM market, over 60 to 70% of their local sales actually go to one customer, and that customer is ZET-DC. So obviously there's high concentration of their sales on the local front, mainly to government, and then they also have an exposure on the foreign side. So in this period of the COVID pandemic, as well as declining aggregate demand, they had to find a way, and that way was through increasing more of export sales. But when you then try to also break down the sales in volume terms, you realize that they were less of copper than they were of aluminium. So that's a high value produce within the matrix of their product. So it also yielded higher or superior margins, resulting in that higher profitability which they achieved. And this is one of the few companies, when you look across the ZSE, which has managed to surpass volume on a year-to-year basis on last year. So this is really something worth noting.
Yeah, an impressive 1.6 billion revenue outturn there. Let's talk about their export exposure or their export penetration. I recall having an earlier conversation with Rob where he, of course, alluded to the need to increase their export earnings, and at the time, their exports were actually beginning to pick up. Can you explain to us the potential markets and how effective their penetration strategies have proved to be as at this point?
So in terms of the prospects in the region, obviously they're quite high. We're just looking at the projected growth in infrastructure across the region in key markets, be it South Africa, be it Zambia, in Malawi, and so forth. So I think there's really scope for growth in this market when you have got industries such as mining, agriculture. As long as those are obviously going up, you expect them to be selling more cable, especially to mining companies, power distribution companies. So I think there's scope as long as there's room for growth, but you're also having to be guided by the constraints in terms of the expected growth in GDP from the region, but particularly those of key sectors such as construction, mining, and so forth. This is where you really realize that demand is going to likely be high. For a country like Zimbabwe, it hasn't been really an expansion drive which has pushed demand. It's really depreciating a depreciating infrastructure, which has called for a need to redo some of that, or retooling in financial language. So I think this is really the drive on the local front. But on the regional front, I think that as long as the region is going to keep on growing and growing out of infrastructure development, there's likely to be a need for more of what the company is selling right now.
Also accompanying the financial statements is the fact that the company has no foreign obligations whatsoever. How strategic is that very position in terms of them being able to capitalize their operations going forward?
Yeah, it's a good thing that they don't have foreign obligations. What it means is that in a volatile economy where there's hyperinflation, you get to have law of foreign exchange losses. But they had a clear monetary loss of upwards of 1 million, which obviously impacted their bottom line as well. So it's quite, there's a payoff whenever you don't have some monetary assets. Either you have put that money into buying stocks, but sometimes you also realize that if you are high on the monetary balances side and in a weaker currency, you then get to realize a depreciation within the currency that you're also holding. So yes, they do not have an external debt, but on the money that they were holding in ZW terms, it depreciated fast enough such that by the end of the period they had a monetary loss of over 1 million. So that's really a cause for concern. But obviously, reducing your exposure in terms of foreign debt in such an environment, which is still obviously not a stable, hyperinflationary exchange rate losses, you would rather do without much of that foreign exposure, just as a short-term measure.
Having looked at the performance of the firm over the past few years, Cafca is a subsidiary of CBI, which in turn is a subsidiary of Renet, which is listed on the Johannesburg Stock Exchange. In terms of return on investment, do you think that over the past few years, the investors within Cafca have been maximizing their returns?
Yeah, so I think when you're looking at return, this is an aggregate normally which is used when you're measuring how companies in a certain sector have performed compared to companies of similar nature in the same sector. So for Cafca, really, it's been a bit volatile, but out of the past 5 years, 3 of those were really in the money, and in some of the years, it really outperformed the market. And to me, that was really a good return. But we're coming from a background where there was SI63 of 2018, which obviously looked at protecting industry, and it helped them a lot. It helped them a lot. Why? Because it stopped a lot of proliferation of these cheaper imports into their space, and so it redeemed their space. But when you look at 2019, it was not so much of a good year. And then in 2020 again, they have redeemed themselves. So I think largely they've remained in the money. The scope for leveraging on parent companies to actually increase in terms of their sales locally. So I think that they could explore this further. They could leverage in terms of bringing in inputs, especially in an environment where you have low foreign currency on the market. So I think there's room to do more.
Interesting. Now let's talk about the production processes that Cafca is actually involved in. This is one of the few value-adding companies that we have in Zimbabwe. How important is that to the contribution towards the national output for the country?
It's a key observation in that within the sector or within the engineering space, you find them to be among one of the few that are really adding value and really creating a real value for the economy. It's unlike your food processing industries and so forth. So one key thing there's less competition, but also you have competition that comes from outside.
Right.
So rather when government really observes that there's such a strategic player, it's really important to attend to their needs, but not to stop them from competition, but really to promote additional production, but at equitable, the product has to sell at equitable prices. So I think it's important to notice such rare gems among local companies and find ways of harnessing their true or potential. So I think it's quite strategic, the positioning that they have in the industry and the value or the nature of the products that they also supply is also very, very important. When you look at ZSE, it's a strategic unit. It's actually nationalized. It's out of the sense that sometimes some of these deliverables have to be closely guarded and closely managed. And so even for those who are supplying the cable, I also think that it's a strategic contribution to the overall output or the overall product which government needs to focus on.
Now, of course, I know that earlier you mentioned how they've got a key player, which would be the likes of ZES and all that would form the clientele for Cafca here in Zimbabwe. Let's talk about the prospects for Cafca that exist within the region. And of course, down south would be perhaps that much of a congested market, so much competition, and also even their parent is playing there. But what growth prospects do you think exist for this firm moving north into Zambia and those northern and countries that you find within the region?
Yeah, so I think I touched on it, but just to emphasize there, I think what you find in the region is an underdeveloped, generally underdeveloped region. So whenever there's room for growth, economic growth, definitely there's room to supply more cable. I gave an example of Zimbabwe just to say our infrastructure has been dilapidated, and obviously Cafca has a responsibility of resupplying some of that cable that we're seeing up there. So for the region as well, as long as the growth prospects, as long as we're looking at developing at a certain scale of 5 to 7% in terms of annual growth, then you expect an infrastructure-led development to yield positives for a company like Cafca. So it's a good thing that the region is underdeveloped. It gives scope for them to push more in terms of these markets, and also they're very close to the market, which means that your cost can also be relatively low and you can fend off competition from some of these countries. When you look at Zim, where we are placed within the region and how easy it is to go to, in different directions of the region, it shows you that our cost might be cheaper than a South African producer based on our route to market. But there are other elements of a final price there that you find. We are talking of your production processes, how efficient are they, which are areas which they might have to really look at. But when you're looking at route to market, economic growth, strategic positioning, we are definitely up there.
Now, the stock price has surged more than 3,000%. How real are these gains, and what do you deduce to be the investor sentiment from that perspective?
Yeah, I think using the stock price gain as a barometer of how the company is doing is not the right thing in the current environment. We have stocks which have netted upwards of 10,000 in terms of year-to-date gains. When you look at companies like BNC, like FBC, CBZ, all those are northwards of 5,000 and so forth. So what does it really mean for the company? I don't think that it speaks much to investor sentiment. Is really a realization that the underlying value or the underlying asset that's represented by a company on the stock market has got a USD value which needs to be compensated for when the local currency depreciates. Why? Because our local market is valued in ZWL. So whenever there's a depreciation in the currency, the value in ZWL of your asset also increases. Just like if you were selling your car at 5,000 in 2015, in 2020 you are multiplying that at a rate. So in the same sense, you are also doing the same to an underlying asset which you believe has got a USD price. So for most of the counters it has been the case, but then you also get to then look maybe at how the company is performing. Like Cafca now outperforming prior year volumes. This means the company is growing. So you have to go beyond just compensating the underlying value of the asset. You now have to look at the prospects of earning a good shareholder return. Then you have to obviously add that to the value of the counter in share terms. So yes, it's likely that the company's share price will obviously go up, but much of that 3,000 gain is reflective of the impact of exchange rate depreciation and inflation.
Well, thank you, Respect, for the insights. Thank you for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our informative website, www.equityaccess.net. Remember to catch us every Tuesday, every Thursday, 7 p.m. Central African time on this very platform. From the Equity Access team and I, Danky, and ciao.